Listen, I know you're sitting there, scrolling through your feed, watching the world change at breakneck speed, and wondering where the hell you should be putting your capital right now. I get it. The traditional playbook is broken. The rules that worked for your parents, they're gone. And if you're feeling anxious about the future, you should be, because we're living through the greatest wealth transfer in human history, and most people are on the wrong side of it. I'm Raoul Pal. I spent years running a hedge fund, advising the world's largest institutions. Now I dedicate my life to helping people like you understand the macro picture, the big forces that shape markets, economies, and ultimately your financial future. I've been in this game long enough to see the patterns, to read the signals that most people miss, and to position myself ahead of the curve. And I'm here to tell you that 2026 is not a year to be passive, it's a year to be strategic. Before we dive in, do me a favor, hit that subscribe button and join this community. Why? Because the information I'm about to share with you is based on decades of research, thousands of hours of analysis, and a network of the smartest minds in finance. This isn't financial advice. I am not your advisor, but it is the framework I use to think about capital allocation in this rapidly evolving world. If you're serious about building wealth, you need to understand what's coming. Let me start with the macro setup, because without understanding the context, you're flying blind. We are in the everything coda period where global liquidity, central bank policy, and technological innovation are converging to create unprecedented opportunities. But here's the thing, most people are stuck in the old paradigm. They're thinking about 60/40ths portfolios, about bonds yielding nothing, about saving their way to retirement. That world is dead. In 2026, we're facing a landscape where traditional safe havens are being redefined. Inflation isn't transitory, it's structural. Central banks have blown up their balance sheets, and the debt levels across the developed world are unsustainable. The old idea of safety being government bonds or cash, that's a losing proposition. Cash is trash when your purchasing power is being eroded by 5, 6, 7% a year. You're not preserving wealth, you're destroying it slowly. So where is the real safety? It's in assets that protect you from debasement, that give you exposure to the future, and that position you in front of the massive secular trends that are reshaping our world. Let's talk about the first pillar, digital assets. Now, I know some of you just rolled your eyes. You're thinking, Raoul, crypto is risky. How is that safe? But hear me out. Bitcoin isn't a speculative gamble anymore. It's a macro asset. It's a hedge against the debasement of fiat currencies. When governments are printing trillions, when debt to GDP ratios are exploding, when trust in institutions is eroding, Bitcoin is the hardest money humanity has ever created. The network effects are undeniable. Institutional adoption is accelerating. We've seen pension funds, sovereign wealth funds, and publicly traded companies add Bitcoin to their balance sheets. This isn't 2017. This is the maturation of a new asset class, and in 2026, with the halving cycles, with regulatory clarity improving, and with the macroeconomic backdrop favoring scarce assets, Bitcoin is one of the safest long-term stores of value you can hold. But it's not just about Bitcoin. The broader digital asset ecosystem is evolving. Ethereum and the smart contract platforms are building the infrastructure for the next iteration of the internet. We're talking about decentralized finance, tokenization of real-world assets, and programmable money. This is where the puck is going. And if you're not allocating at least a portion of your portfolio to this space, you're missing the biggest wealth creation opportunity of our generation. Now, I'm not saying you should go all in on some random altcoin that your cousin told you about. Risk management is everything. I am talking about a disciplined approach, allocating a percentage of your portfolio to blue-chip digital assets with strong network effects, strong development teams, and strong use cases. Think about it like the early days of the internet. Would you have wanted to own Amazon in 1999? Of course, but you also needed the stomach to handle the volatility. The second pillar is equities, but not the way you've been taught. We're living through the fourth industrial revolution. Artificial intelligence, robotics, biotechnology, these are the sectors that are going to define the next decade. The companies building the infrastructure for AI, the ones processing massive amounts of data, the ones creating the tools that make us more productive, those are the businesses you want to own. In 2026, we're seeing AI move from hype to reality. The demand for compute power is insane. The companies that own the data centers, the chip manufacturers, the cloud providers, they're in a position of structural advantage. This isn't speculation. This is following the money. Governments are investing trillions into digital infrastructure. Companies are spending billions on AI capabilities. If you own the picks and shovels of this revolution, you're going to do extraordinarily well. But here's the key. You need to think globally. The US market is expensive. Look at emerging markets where the valuations are more attractive, where the growth rates are higher, and where the demographic trends are in your favor. India, Southeast Asia, parts of Latin America, these regions are going to see massive growth as the middle class expands and as digitalization accelerates. The third pillar, and this is where people often get confused, is real assets. I'm talking about commodities, about energy, about the physical stuff that the world needs to function. We've underinvested in commodity production for over a decade. We've demonized fossil fuels without having a realistic transition plan. And now we're facing shortages. Copper, lithium, uranium, these are the materials required for the energy transition, for EV batteries, for nuclear power. The supply is constrained and the demand is exploding. In 2026, you want exposure to these supply-demand imbalances. Whether it's through commodity futures, through mining equities, or through physical holdings, this is a multi-year bull market that's just getting started, and it's not just about speculation, it's about recognizing that the world is changing, that we're electrifying everything, and that the raw materials to do that are scarce. Let me talk about the mindset you need, because strategy without psychology is useless. The biggest mistake I see people make is thinking short-term. They panic at every 10% drawdown. They sell at the bottom and buy at the top. They let fear and greed dictate their decisions. If you want to build real wealth, you need to think in cycles, not in days or weeks. Zoom out, look at the bigger picture. We're in a long-term bull market for risk assets, driven by liquidity, driven by technology, driven by demographics. Yes, there will be corrections. Yes, there will be moments of panic. But if you have conviction in the macro thesis, if you understand the forces at play, you stay the course. You rebalance during the dips. You add to your winners. This is also about diversification, but smart diversification. I'm not talking about owning 50 different stocks just for the sake of it. I'm talking about building a portfolio that gives you exposure to different macro regimes, digital assets for debasement protection, equities for growth, real assets for inflation protection. And yes, some liquidity for opportunistic deployment when everyone else is panicking. Tax efficiency matters too. In 2026, you need to be thinking about jurisdictions, about structures, about how to legally minimize your tax burden. Every dollar you save in taxes is a dollar that compounds for you. If you're a high earner, if you're a business owner, you need to be working with professionals who understand international tax planning, who understand how to structure your holdings in the most efficient way possible. Let's talk about cash flow because this is critical. I am not a dividend guy in the traditional sense. I am not interested in utility stocks yielding 3%. I'm interested in assets that appreciate and throw off cash in the digital asset space. That's staking, that's yield farming in decentralized protocols. In equities, that's companies with strong free cash flow that are buying back shares or paying growing dividends. In real estate, that's industrial properties in strategic locations or data centers that have long-term contracts. The key is that you want your capital working for you 24/7. You don't want dead money. You don't want assets that just sit there hoping they go up. You want compounding machines that reinvest, that grow, that create exponential returns over time. So what's the action plan? What do you do starting right now? First, you get clear on your time horizon. Are you investing for 5 years, 10 years, 30 years? The longer your time horizon, the more risk you can take, the more you can allocate to high growth, high volatility assets. If you're thinking decades, you should be heavily weighted toward digital assets and next generation equities. Second, you build your base layer. This is your core allocation, the 60-70 of your portfolio. That's in liquid, relatively stable assets. For me, that's Bitcoin, that's large cap tech stocks, that's some exposure to commodities. This is your foundation. Third, you allocate to asymmetry. This is the 10-20 of your portfolio where you are taking calculated risks on things that could 10x or 100x, early stage crypto projects, pre-IPO companies, venture investments if you have access. This is where the life-changing wealth gets made, but you have to be comfortable losing this capital. Fourth, you stay liquid. Keep 10-20 in cash or cash equivalents so that when opportunities present themselves, and they will, you can move quickly. The best investments I have ever made were during moments of panic when everyone else was selling and I had dry powder. Fifth, you educate yourself relentlessly. Read the research, listen to the smartest people, challenge your assumptions. The world is changing fast, and if you're not learning, you're falling behind. Follow the on-chain data, understand the flows, read the Fed minutes, watch the macro indicators. This is a full-time job if you want to do it right. Finally, you think globally. The US is not the only market. In fact, some of the best opportunities are outside the US. Be willing to look at Singapore, Dubai, Switzerland, places that are building pro-innovation, pro-capital frameworks. Your wealth is global. Your mindset should be too. Look, 2026 is going to be a year of extremes. We're going to see massive volatility. We're going to see incredible opportunities. The people who understand the macro picture, who position themselves correctly, who manage risk intelligently, they're going to do extraordinarily well. The The people who bury their heads in the sand, who stay in cash, who refuse to adapt, they're going to watch their purchasing power evaporate. I want you on the winning side of this. I want you to look back 5 years from now and realize that this was the moment you took control, that you stopped being reactive and started being proactive. If this resonated with you, if you see the opportunity ahead, then I want you to engage with this community. Leave a comment below. Tell me what percentage of your portfolio you are allocating to digital assets in 2026. Be honest. I want to see where you are in your journey. Share this with someone who needs to hear it. Hit the like button to help the algorithm spread this message. And if you haven't already, subscribe and turn on notifications, because we're going deep on these topics all year long. The future is being written right now, and the best part, you get to be part of writing it. Now go position yourself for what's coming, because the opportunity is massive, but the window won't stay open forever. Are you ready to dive deeper into any specific asset class for your 2026 strategy?